Well, unless you've been living under a rock, you probably heard about the collapse of FTX, one of the world's biggest cryptocurrency exchanges. In the past few weeks, its founder, Sam Bankman-Fried, also known as SBF, was responsible for losing around 10 billion of his customers' assets. Sam Bankman-Fried has no qualms about discussing his business practices with others, even when they have seemed risky. In fact, he was quoted as saying that some crypto exchanges were secretly insolvent. Last year, upon declaring his net worth to be around $10 billion, he stated that it was most illiquid assets. Furthermore, when Bloomberg's Matt Levine suggested during an interview last April that he might be in the Ponzi business, rather than disagreeing outright, Sam simply agreed. I think that's a pretty reasonable response. It was only a matter of time before he collapsed. However, because people were blinded by his success, they didn't see or hear the warning signs. His employees, customers, and investors saw how much money he was making from his crypto market makers, including FTX, and turned a blind eye to what he was saying. So, how did it all happen? How did Sam lose billions of customers' funds? Let's find out. Sam first got into cryptocurrency trading in 2017. He had just quit his job as quant trader at Jane Street and saw an opportunity in his new hobby. The price of Bitcoin was valued differently in exchanges across the globe. If he could buy low and then sell high in another region of the world, he realized that he could build a trading floor around Bitcoin arbitrage. He established Alameda Research with about 15 workers and traders, along with colleagues from Jane Street, like Caroline Allison. Others included Nishat Singh, whom he had met through the Center of Effective Altruism, a group of wealthy people dedicated to donating much of their money. According to one early Alameda employee, his goal back then was to make $1 billion. Alameda traders really were beholden to what SBF was doing. He was the head trader, and they were the foot soldiers. Another one of Alameda's earliest employees stated that Sam always wanted to take greater risks than the other were comfortable with. More specifically, he would argue against any post by other members suggesting they should slow down on trading. And he also didn't worry too much about getting money out of unreliable exchanges. The employee continued by saying that everyone trusted and believed in Sam because it was a dictatorship in a good way. A benevolent dictatorship. Imagine seeing your boss making increasingly risky moves and thinking that's a good dictatorship. That's terrible. Sam had his sights set on bigger opportunities than Bitcoin arbitrage when he approached Binance in 2019 with an idea to launch a futures trading desk, according to former Alameda employees. Even though Binance wasn't interested, the company's CEO, Changpeng Zhao, or CZ, did agree to join an initial funding round for SBF so that the FTX could be launched as his own exchange. From then on, we were wondering if we were supposed to be an exchange or a trading firm, another former employee said. They couldn't differentiate between the two. FTX always relied heavily on Alameda. Sam's image only seems to grow as FTX became more successful, with multiple magazine covers featuring him and his story of success. In little less than 2 years, he was able to raise $2 billion in total. During one business meeting that was held over Zoom, SBF caught the attention of the Sequoia partners. One partner even wrote in chat box, "I love this founder." And this, folks, is just a reminder, even though someone is successful, their opinions are not always right. In July 2021, Sequoia joined SoftBank and other investors in FTX $900 million Series B funding round. Months later, after another funding round, investors valued FTX at an impressive $32 billion. According to a report from The Information, Sequoia also engaged in the unusual arrangement of accepting hundreds of millions of dollars from Sam himself as a limited investment partner in one of their funds. SBF's generous donations to charities, non-for-profits and sports sponsorships have furthermore boosted the myth around him. For one deal, he promised $17.5 million to UC Berkeley in cryptocurrency for the naming rights of their stadium. He gave a reported $10 million towards a partnership with Golden State Warriors, plastering FTX signage throughout the team's San Francisco arena. He then signed a 19-year deal to rename the Miami Heat home court FTX Arena. SBF also became powerful donor in Washington, giving nearly $69 million to politicians and PACs before the midterm elections. He also met with Republican Maxine Waters and other lawmakers, supporting a bill introduced by Senators Cynthia Lummis of Wyoming and Kristen Gillibrand of New York. "My giving has been participant," he said, "and my goal is to help support great policymakers." Sam's original Alameda team remained together throughout their journey. In July 2021, when Sam stepped back as CEO of Alameda to focus on FTX, Caroline Ellison, his alleged romantic partner and co-worker, was appointed co-CEO of Alameda alongside Trabucco. They then set up a headquarters in the Bahamas. SBF's trading firm made more and more daring bets as the fairy tale surrounding him grew. However, in June everything changed when the Three Arrows capital collapsed, leading Alameda to use FTX customers' assets to cover their own losses. In fact, most of the risky bets at Alameda were allegedly fueled by FTX customers' deposits, which its executives, including SBF and Caroline, have reportedly admitted knowing about. FTX was loaning out its customers' funds to Alameda in exchange for collateral. You might be thinking that's alright because there were collateral to cover customers' assets. But you're wrong, because this is where it gets messy. The collateral they were using was in the form of FTT tokens. It's a token used by FTX itself. It's like loaning money from a bank and giving them their own stock as collateral. It's incredibly bad. Why? Let me give you an example. Let's say your bank. Your customer gives you $1 million to store. Now you loan out that $1 million to your friend Jim in exchange for collateral in the form of a home worth $1.25 million. If your customer suddenly wants their $1 million back, you can give it to them immediately because you don't have $1 million cash. You try to get Jim to return the money, but he couldn't do it because he spent it. But in this case, the customer's fund is still safe because it's covered by the $1.25 million home. You can sell the home and give your customer the money back. They just have to wait a bit. This is called a liquidity crunch. Now imagine the same scenario, but instead of a home, you get the $1.25 million collateral in forms of your bank shares. Is the customer's fund safe? The answer is no. When you face a liquidity crunch, the public will get whined about your bank's poor condition. It will cause the price of your share to plummet because nobody wants to trust a bank that couldn't pay out their own customers' own money. Suddenly, the 1.25 million shares drop down in value as your own share price falls. When the value goes under $1 million, you're not facing a liquidity crunch anymore, you are insolvent. And that is what happened with FTX. They used assets they created themselves as leverage to fund their bets. They started controlling the prices of these assets to make it look like they held a large amount of money. How? For example, if Alameda funds a project with $1 million at $5 million valuation, meaning they would get 20% of the tokens, and FTX then lists the token but only releases 1% to the market, leaving supply low. Thus, Alameda could use a few $1 million to prop up buy orders and create an inflated, fully diluted valuation of, let's say, $500 million. Now, their initial investment is worth 100 times more on paper. By doing this, Alameda employs a strategy that gives the illusion of having a large and diverse balance sheet to potential lenders. With this collateral, they can borrow more funds for investments. However, employees who spoke out against this practice are met with threats from Sam. Alameda's $10 billion hole probably occurred in this way. Alameda pledged collateral that wasn't easy to sell to borrow money for bets. When the crypto market crashed, they got margin called. To cover this debt, they start taking user funds out of FTX and moving them to Alameda. This action likely left FTX with less liquid reserves than what users had deposited. There is a great risk that comes with all of this. If the price of these tokens happens to crash, Alameda will be forced to liquidate along with FTX. This is probably the reason behind FBS's massive push for legitimacy, with their marketing spending, charities and political lobbies. These actions were taken to secure FTX equity value and the FTT token, so they would not collapse. However, it all started to crumble down for Sam. On November 2, 2022, CoinDesk released a report regarding Alameda's balance sheet. They found that a large portion of Alameda's $14.6 billion in assets are assets issued by the FTX team itself. On November 6th, CZ made an announcement that shocked the world. He said that Binance would be selling all $584 million of their FTT tokens, a move which would cause the price of FTT to drop sharply. This was devastating news for FTX and Alameda, who both feared for the future. In response, the CEO of Alameda said that the balance sheet doesn't reflect around $10 billion worth of assets. Sam echoed this statement shortly afterwards. These statements only added to fears that perhaps Alameda and and FTX are more likely linked than anyone previously thought. It started cascading and users started withdrawing their funds. It ended up becoming a bank run. Withdrawing assets from FTX was the best option and the most logical move. Think about it. If FTX went under, then at least your assets were safe elsewhere. And if they didn't go insolvent, you would only lose out a small withdrawal fee. Finally, on November 11, 2022, Sam filed for Chapter 11 bankruptcy in the United States. Investigation revealed that out of the $10 billion FTX user fund ship owned by Alameda, $1 billion still missing. It was later found out that exactly $1 billion of user funds were loaned out to SBF himself. Of course, Sam denied his involvement. He said that he wasn't aware of everything that happened. But the court found out that he knew a lot more than what he has said, and the most of the decisions were made by him. Sam was arrested in the Bahamas on December 12, 2022, after US prosecutors filed criminal charges. He is facing 115 years prison sentence. So, what do you think? Was it just mismanagement, as claimed by Sam himself, or is he just a scammer trying to steal other people's money? Let us know in the comment section below. Click like and share if you enjoyed this video. Hey, you there, our tech buddy. Do you like this video? Then subscribe to our channel. That would help us a lot. See you later. Bye.